Oil just crossed $100 a barrel. The S&P 500 fell for a third straight week. Gold is above 5,000. The VIX is sitting near 28, and the Fed meets in 3 days with no good options. This is the week you need to understand. Let me walk you through exactly what happened, what it means for your money, and what comes next. The S&P closed Friday at 6,632. That's down 1.5% for the week and 5% below the recent high. 3 consecutive down weeks. Brent crude punched through $103 a barrel. Gold is above $5,100 an ounce, and the volatility index, the VIX, settled at 27.38. Those are not small numbers. They tell you that institutional money is repositioning, fear is rising, and the safe haven trade is on big way. I was working with a client this week who called me on Tuesday morning worried about the headlines. What I told him is the same thing I'll tell you. The numbers matter more than the noise, so let's go through them. Every major U.S. index closed lower. The spiders, the S&P 500 ETF, SPY, fell 1.5%. The Qs, QQQ, the NASDAQ 100 ETF, lost only 1%. But the equal weight S&P 500, the RSP, dropped 2.3%, and the small cap Russell 2000 index, IWM, shed 1.7%. So pay attention to that gap between the spider and the RSP. When equal weight underperforms the capitalization weighted by that margin, it means the average stock did worse than the big cap giants. That is broad internal weakness. The selling was not confined to a handful of names. It was everywhere. Small caps took the heaviest damage. Credit-sensitive companies buckled under rising yields and recession fears. Only 2 sectors finished in the green. Energy, of course. XLE, that's the energy sector ETF, gained 2%, riding the Iran-driven oil surge. Brent settled at $103, WTI at nearly $99. That powered broad gains across exploration and production names. Utilities, XLU, gained 0.5% as investors rotated into yield and safety. The bottom of the board was ugly. Financials, the XLF, dropped 3.3%, the worst sector for the week. Rising long-end yields collided with fears about loan quality and slowing deal flow. Consumer discretionary and industrial sectors both fell 3.1%. That's with tariff uncertainty, supply chain disruption from the Hormuz closure, and a broad risk-off mood hit them the hardest. So, some notable movers, though. On the winner side, of course, dominated by energy names, APA Corporation led the S&P 500 for the month. Direct beneficiary of surging crude, Diamondback Energy, our stock, ticker symbol FANG, F-A-N-G, climbed near its 52-week high at $182. On the losing side, Adobe dropped another 7.6%. 2 things hit at once. CEO Narayan announced he's stepping down after 18 years at the helm, and management disclosed that about $70 million of ARR miss came from customers generating their own visuals, AI tools, instead of buying stock photography. Leadership change, plus the revenue loss from AI cannibalization, spooked investors even more. Meta, Palantir, and Oracle all fell between 1.7% and 3.8%. The selling in big tech was broad, but contained because there is a flight to safety in bigness. Economy and the Fed. Tuesday's February inflation CPI report came in clean. Consumer prices rose 0.3% for the month, putting the annual rate at 2.4%. The core CPI posted 0.2% for the monthly and 2.5% annually. Both numbers matched expectations exactly, but here's the problem. That data was collected before the Strait of Hormuz closed and sent energy prices spiraling upward. The February CPI is already stale. March and April readings will tell a very different story, probably. The labor market is cooling. The January JOLTS job report showed 6.9 million openings. The March payrolls report, remember, shocked everyone last week with a net loss of 92,000 jobs. Weekly claims climbed to 222,000 this week. Consumer sentiment dipped to 55.5. And in that report, one-year inflation expectations held steady at 3.4%, but will likely change now that we have the oil shock. And we're also going to have a food price shock because oil is an input into fertilizer, and that means that food's going up too. The Fed is stuck at 3.5 to 3.7%. The Fed Watch shows a 99% chance they hold steady on March 18th. Inflation's about to reaccelerate from the energy costs while the labor market continues to soften. That is the textbook definition of stagflation, and it ties their hands for now. Quick pause here. If you're getting any value from these weekly breakdowns and you want to understand how we think about building portfolios that hold up through weeks like this one, I made a video that breaks down the 3 buckets we use to select every stock in the VAP portfolio: ownership companies, monopolies, and oligopolies, and cannibal companies. The link is in the description. The war with Iran is the single most consequential variable in this market right now. Since U.S. and Israeli forces launched the coordinated strikes on February 28th, Iran has effectively closed the Strait of Hormuz. That choke point handles roughly 20% of the world's daily oil supply. The IEA estimates the closure guts global supply by about 8 million barrels a day. 30 nations agreed to coordinated strategic reserve release of 400 million barrels, the largest in the IEA's 50-year history. The U.S. committed to 172 million barrels from our Strategic Petroleum Reserve. Here's the catch. That oil takes about 120 days, 4 months to reach the market. The supply gap from the Hormuz closure will persist well into the summer. Gas prices have already climbed to $3.50 per gallon nationally, up 20% just from a month ago. Announced the largest wave of U.S. strikes against Iranian targets this week. This situation's not resolving quickly, unfortunately. 3 catalysts next week. FOMC decision on March 18th. No rate change expected, but Chair Powell's press conference and the updated dot plot could move markets if the Fed signals any willingness to cut sooner to buffer the labor market or later because of potential inflation. February PPI data also arrives March 18th, and Accenture, our stock, Accenture, also a bellwether for IT tech and the revolution in companies adopting artificial intelligence. A report on March 19th, a bellwether certainly. So we'll be watching that closely. 2 scenarios. The constructive path is the Fed's tone signals readiness to ease in the second half. The IEA reserve release begins flowing faster than expected, and any hint of de-escalation in Iran compresses oil prices and triggers a relief rally. Under that path, the S&P 500 could reclaim 6,800 by month end. The adverse path, of course, continued escalation, Brent sustaining above $110 a barrel, a hawkish Fed press conference, and a hot producer price index print. That pushes the S&P 500 toward its next support near 6,400. Energy outperforms, everything else struggles. Now the VAP portfolio for last week. I am going to be straight with you. It was a tough week. The portfolio declined 3.5% net of fees, as more than double the S&P's 1.5% decline. Year to date, we are down 7.3% net versus the 2.9% for the S. I had a conversation with a long-term client on Thursday who asked the right question. Does the one-year number still hold? The answer is yes. Over the trailing 12 months, VAP has returned 16.9% net of fees, and that is the compounding thesis in action. A concentrated portfolio amplifies in both directions, of course. When markets sell off broadly and defensive energy stocks lead, a portfolio built around growth compounders and high-quality operators will take more short-term damage, and that's what's happened. That is the trade-off. We accept short-term pain for the long-term outperformance, and that is what we'll do. The top 5 weekly performers in our portfolio were, number 1 was ASML. It led the portfolio 4%, make the only EUV lithography machines on Earth, the only ones, the equipment that required to produce the absolutely most advanced semiconductor chips, and that is a monopoly on those machines right now. Record quarter Q4 orders of 13 billion euros, 144% quarter-over-quarter growth. That, of course, crushed estimates. Management raised their 2026 revenue guidance to 34 to 39 billion euros. The AI infrastructure build is accelerating, and ASML sits at the bottleneck. Permian Resources, ticker PR, gained 2.7% last week, up nearly 38% year-to-date. It's a direct beneficiary of the surging crude prices, of course. Piper Sandler, the brokerage, raised the price target to $24. NVIDIA added 1.4%. Alphabet, Google's parent, gained 1.3%, outperforming the broader sector. And Diamondback Energy, the oil and gas stock that we own, FANG, F-A-N-G, rose 1%, trading near its 52-week high. The theme of all the winners, AI, infrastructure, and energy ownership, provided the offsets to this week. The bottom 5 performers, here we go. The losses. Ulta Beauty was the largest single detractor from performance. It was down 17% for the week. Revenue of $3.9 billion came in way above expectations, but net income declined 9.3% year over year. That was expected, but operating margins contracted 220 basis points. Their selling, general, and administrative expenses, SG&A, spiked up to 23% growth. That's the classic case of investment. Management guided fiscal 2027 comps at just 2.5% to 3.5%, which is half of what they were for last year. Franchise and cash generation remain really strong. They're going to buy back more, $3 billion worth more stock, but this is margin pressure at a time when the consumer is already weakening. Now, Copart salvage auction year fell 10% for the week, hitting 52-week low. The global insurance units for Copart, I think not this past week, but at the end of last week, at the end of the previous week, the units declined 9%. Revenue dropped 33.6%. Cyclical, and backed at the view with over 500 million buybacks. Now, they had paused their buybacks for a number of years because they were in investing mode. They were buying land, and they were buying that overseas so they can expand overseas. That's good. We like that. We think they're going to have very high returns overseas, just like they have here. Hitting the stock, they think that they've got a bargain, so management restarted the buyback, and they're going to buy back $500 million or more with that record $1.4 billion in free cash flow. At 21 times enterprise value to free cash flow, patient owners should just simply be paying attention. Now, if they're buying back stock, that's the reason why we put Copart in the portfolio during this time. I like to buy companies at a transition when the market doesn't like that they were investing on the income statement. But if you get a very good, like an ownership-oriented management like these guys, you know they're going to be buying back oodles of stock, and we're getting under intrinsic value, which is where we think and they think we are now, and that's why we bought some more. ServiceNow dropped 8.6%. Accenture fell 8.5%. Thermo Fisher lost 7.5%. The common thread, high multiple growth stocks getting re-rated as AI disruption fears meet a weakening macro backdrop. 3 things to carry into next week. 1, the Iran-Hormuz situation is a real supply shock with no clear timeline for resolution. A lot of guesses, a lot of generals, a lot of admirals, and a lot of people that think they know what's going to happen. We don't. So we got to be prepared for anything. So energy prices are probably going to stay elevated until the Strait opens or an alternative supply fills the gap. Both will take months, not weeks. 2, the Fed's March 18th decision and press conference will frame the policy debate for the rest of Q2. If Powell acknowledges the stagflationary risk without ruling out rate relief, that could stabilize sentiment. A purely hawkish stance would hurt growth stocks even further, though. Number 3, the sell-off in businesses like Accenture, ServiceNow, Thermo Fisher is creating entry points that long-term owners are going to evaluate carefully, like us. These companies generate real cash flow and hold very strong market positions. The question is always whether the current price reflects a permanent change in the business or temporary shift in sentiment. And for the names in this portfolio, the answer, the latter. It's just a temporary shift. We've been doing a ton of work on artificial intelligence. You can check out the YouTube channel. We've got a couple of good sources in there. So far, our conclusion is that we think that the market and a lot of gurus, pretend gurus, anyway, got this all wrong. What we want to focus on is the massive decrease in the cost of making existing software better. And when you can make the existing software better and replace in your client companies a bunch of positions with agents that you make, you can also reap the rewards of replacing the salaries of those agents. So people with the thought that they're going to constantly have a problem with Accenture and ServiceNow are going to have artificial intelligence eating away their customers. We think it's just the opposite. We think that there's a huge opportunity for Accenture to put in safe AI into businesses and for a company like ServiceNow and for Salesforce.com to replace a ton of labor costs in their customers and then take a not so insignificant percentage of that value at the same time saving their clients an awful lot of money at the same time. These companies, like I said, they generate cash flow, hold strong positions. So own good businesses, stay invested through the volatility, and the compound is always continuing. Even though it doesn't feel like it, remember, it always continues. The market in its history has always recovered. I don't see any reason why. I can't guarantee it, but I can't see any reason why this time is any different. If you found this useful, you're going to want this one right here, where I break down the 3 types of companies we buy and why we compound through the cycle like this. That link is in your screen now. I will see you next week. Bye-bye.